Hello, everybody. This is Gary Mettler and I discussing immediate annuities. He's a wealth of information. Enjoy. Okay, so this is Gary Mettler. Gary Mettler and I have known each other since I started in the business. My dad was friends with Gary, and they worked together closely while Gary was at Presidential Life. And if we had a question about immediate annuities, Gary is on the, we call Gary. Gary is our guy. He's the guru. He actually wrote a book, and I'll let him tell you all about that, on immediate annuities. So the
Right.
immediate annuity, kind of, we were just discussing, Gary and I, that it's almost like a lost language. It's not talked about enough. And
Right.
I would like Gary to get into the specifics of the safety of them and just share some of your experience, Gary,
Right.
of what you've seen in the past, where you think maybe the future, where SPIAs might play a part in the
Right.
future with the current environment, and any other beautiful knowledge you'd like to impart to the wonderful independent agents that follow me. So,
Well, you're right, Jeff. It is kind of a lost language because, for so many years, we basically, and because of the desires of life insurance companies, everyone's become a savings account company, and basically deferred annuity, and all these other things people have, mutual funds, stocks and bonds. These are all savings devices. When you boil it right down to it, they're, immediate annuity is a future income device. And so it's kind of become a lost language because carriers have said, well, we really want to be in the savings markets. We want our agents to sell savings contracts. We want to manage savings contracts. We don't want to get involved with these fixed payment contracts that are way out in the future. And it's not our thing anymore. And so as time has gone by, this has been slowly lost. And I think there might be a time coming now in the future that they may become more prominent, only because, and we're going to talk about this, which is the safety issue. Okay, so for 20 years, we've had 0% interest rates. Everyone went hog wild with the markets and real estate, everything else, and no one thought about it. But now we got interest rates, right? And they are competing now with these other things people were doing. And there's a big shakeout going on. Anyone who's in the market knows exactly what I'm talking about. Okay, so this is what's happening now. So people will start reevaluating what it is to be safe, what it means to be safe. Okay, so as the years went by, all the years I've been doing this since 1983, there's been survey after survey of consumers. I can't tell you how many surveys have been done. The number one reason people always buy fixed annuities, no matter what is going on, is safety. Safety is the number one purchase reason. No matter how many years have gone by, it's always the number one reason. So an agent needs to keep that in mind when presenting also the fixed deferred annuity, but also a SPIA, because that's the selling point that consumers want to hear about. That's the safety issue. The second benefit that comes in line is always a tax benefit. That's a secondary interest. It is interesting. SPIAs do have, some unique tax benefits, and they have, a lot of people like SPIAs. The federal government likes SPIAs. The state governments like SPIAs. They have probably more tax benefits with them. They have better protections with them, that type of thing, with the state. So people like those contracts. So tax benefits are the second reason. The third reason is this, I call it the academic reason, is, worrying about what your income is going to be 30 years from now. So that's like the last thing to a consumer. Now, thank God we have the academics, because they're in our corner. They're the one group, a powerful group that's promoting pensions, immediate annuity contracts that we have that's still left in the industry to consumers, basically. So they're in our favor. But they got this thing where they highlight, well, if you're 65, you just have to buy this contract, because in 30 years from now, you may run out of money. Well, that looks good on a spreadsheet in Excel. When you're talking to a real person, they care less about what happens 3 years from now, right?
yeah.
So what they're really concerned about is what's going to happen tomorrow, because I'm going to live tomorrow, right? Probably. Or they're concerned about, well, my taxes be next year. Why? Because they're probably going to live next year to pay taxes, right? So those are the two most important things to them. This reason of buying something you're going to need to run out of money 30 years from now, that is not important to an average consumer. I mean, it looks good on paper, but it's not a selling point. And I tell agents all the time, really don't even mention it. just talk about the safety features of the contract, and talk about the tax limits perhaps if you have to, but maybe not so much that, because that's a distraction, I think, in the selling process. Right?
And if we want to get into the safety, what makes the SPIA, the immediate annuity, more safe than another annuity, say if an insurance company should get into a receivership position or worse?
Well, so there's different elements. So when you say safety now, people, when they think about safety, because they haven't come up from an investment background, they're thinking two things. They're thinking safety for two reasons. One is market safety, volatility issues, right? It's not volatile. So that's one type of safety. The second type of safety is credit default. But that's the limit. So you talk to people, when people talk about safety, that's what they usually talk about. And to honestly, Jeff, it's not enough. That is a very limited safety approach. You make sure you remember what you're doing. You're asking a consumer to spend 6-7 figures with a premium for a contract that they're going to have forever. So you just can't give them a couple of good reasons. You have to give them like a compelling reason. You have to compel them. I want to buy that contract. Okay. Credit default, market volatility, those are all good reasons, but they're just not compelling enough. Okay. So what are the issues that SPIA addresses safety-wise versus these other things? And this include not just deferred annuities, but mutual funds, stocks and bond accounts, passbook savings. Maybe I have, U.S. savings bonds. That's a treasury security of some kind, savings bonds, right? Maybe I have that. Well, the problem with all that is if you get into a real jam of any kind, which we may be looking at in the next couple of years or so, that's all lapsable. And that's my biggest thing I point out. Well, those things are only good if the consumer doesn't lapse it. And lapse is the industry term for, taking an in-force contract and surrendering the contract, right? Well, if you can lapse it, well, what kind of protection is that? So SPIA is a non-lapsable issue. You're not going to be able to lapse it. Okay, so no matter what happens to you in the future, and I'm not talking about the market things, what happens to you in the future, you're going to have that income coming in. You can't lapse it. So that's one of the problems, I think, with the deferred annuity side, is they don't think about that. I bring that up all the time. And of course, that's the ugly thing. Well, it's not our fault. If the consumer lapses, they'd lapse, but that's not our problem, right? That's what the industry will say to you. And when you look at, you ask them about deferred annuities, particularly if that's what we do, deferred annuities, they'll say, well, we don't, that's not our issue. It's not our control. We can't control that. In fact, when they price their contracts, they price as FIAs with riders, other types of contracts, they use lapse support. And that's how, the reason why FIAs look so good is that carriers already know, I estimate about 15% of the contracts will probably lapse over the life of the book.
You think it'll be that high, huh?
Well, that's what the carrier, that's what we use. We use more than that. We use a lapse rate of, if we had a MIGA, we'd use a 40% lapse rate at the end of the term. At the end of the term, yeah. Of course, the lapse rate is really looked at the whole book, basically. But these lapse rates spike depending on the contracts, But typically an FI rider will look at somewhere between 12 to 15% lapse rate over the long term of the block, So it's not a majority. So there's a minority of people, right? They're going to lapse, but still, we think will happen to lapse rates if the economy falls apart. Well, they'll probably rise, right? People will lapse their deferred annuities or lapse their life insurance. I mean, they're not sacred. Mutual funds will lapse. All these assets are going to be gone. They're going to be used to support whatever's going on in their life. They won't have the future income. They've surrendered it basically for other purposes. So the idea, when I talk about safety, I talk about safety in those economic terms. Well, there's something you're going to have. It's going to be the future. It's going to be paying you, and
almost protecting the consumer from themselves.
Well, not from themselves, nothing but things that happen to them. It's not their fault. I mean,
just from them taking their money.
You get sick or injured, you lose a business, you go through divorce. Is that your fault? Well, I don't know, maybe not. I mean, these are all things that happen to people that cause them to dissipate, lose money, right? It's not just market events. These are everyday life happen events. You go through an earthquake. Well, I went through an earthquake in California, right? I lost everything. Was it my fault? I was in an earthquake? No. Wrong place, wrong time. Didn't matter if I was a PhD or a, most brilliant person on earth. I mean, you just went broke along with everyone else did because it was what happened. And so I use that example a lot. And people, of course, it's an insurance example. So people say, oh, well, that's not me. And that doesn't happen to my clients. My clients, God loves my clients. Nothing happens to my clients, they're bad. That's the way the clients think too. They think that nothing happens to them either because, it's always the other person it happens to, but that's just never the case. And so the idea is to have this kind of a non-lapsable product that's going to be throwing off income to you in the future, that it's, you don't have to make any decisions about it. There's no actions you have to take, nor are there actions that anyone else can take.
Yeah.
Right.
And so like if you got into the earthquake, you'd get your money from a deferred before an immediate, and then down the road, you wouldn't have that income.
Yeah. I know people had deferred annuities and whole life. Guess what happened to those policies? They're all surrendered pretty much. Yeah. So that's the problem with that. So you want to make sure that you have, and again, it's a strange asset class. It has value mainly because it's illiquid. So that's the value.
It's good and it's bad. You can't get your money, but it's
exactly
bad
right.
in the short term, maybe, but in the long term, you'll always have that kind of helping you out.
What people have today is basically Social Security. That's the only non-lapsable asset they really own is Social Security. Everything else is subject to be gone. So the problem is Social Security is just not adequate enough, and as your household ages, right, when one of your spouses die, part of your social income goes away, right? So your annuitized wealth, your non-lapsable wealth starts to diminish as you get older and older. So that reliability isn't there anymore. Now you're looking at your stocks, your bonds, your deferred annuities, and if things don't go right, guess what? You're probably going to have a diminished standard of living, and that's the whole reason why you have these special rules. You got special tax privileges, which we go into. You have bigger state protections for immediate annuities. Why? Because they're like pensions. All right. They're there to protect people from becoming completely dispossessed. Right. You're going to have this income coming in, and to have this income, that's why you have, the QUAC rules, and why you have stretch IRA rules, and why you have these special rules carved out for these contracts, because the government realizes that this is, why they don't want you falling back on the government dole. They want you to have some income coming in while they favor these kinds of contracts so that you can sustain yourself. You don't have to go back on welfare. You don't have to go to public services. You've got money coming in on your own accord to where that won't be necessary. So that's one reason why pensions have favorable tax rules. That's one right. Immediate annuities have favorable tax rules. State protections. You look at New Jersey, for example. Your new company gets in your jam in New Jersey. Guess what? Well, if it's a deferred annuity, it's a cash value annuity. The state guarantee fund will only back $100,000, right? Were they back for an immediate annuity? $500,000.
Wow.
So and they're the extreme, right? But a lot of states have these differentials on what they will back for immediate annuities that are higher than what they are for deferred annuities. Again, it's the same idea, is that it's annuitized, it's coming in future income, it's there to protect you from, going entirely broke, basically. And when I mean broke, I don't mean going to zero, Jeff. A lot of people think when I say broke, I mean zero. That's probably not going to ever happen. So when I say broke, I mean a significant change enough in your wealth to really impact your lifestyle. So that's because if you ask a person who had $5 million, who now only has $1 million, say lost it in, Carvana or something. Okay. You know what they're going to tell you? That person will tell you they're broke.
Yeah.
Because it's how they feel.
And what they're
not that they're actually dollar broke.
Yeah.
But that's what I'm saying. So when I talk about going broke, this is more to keep your lifestyle up. That's the idea behind it. So that's what I mean by
almost like they're a protected class in a way.
Yeah. So that's the idea. That's why you have some special rules. Immediate annuities has some special tax benefits, non-qualified do, or even the qualified. they've got additional benefits that deferred annuities don't have. I mean, the government just likes them. They protect society better. And the reason why they protect society better is because their future income versus a savings account, right? So, I go through this all the time. I was in California. I was really big in the divorce business. I did a lot of divorce work. And my role was to evaluate mostly pensions, but qualified plans and whatnot, for marital property issues. And then they were being divided, so that was a whole big business. But then after the earthquake in 94, and that's why I lost everything in the earthquake in 94. That's how I got my footing back, is that I lucked out. I found somebody, started working this one company. And because people had lost so much after the earthquake, because people didn't really see that. What people saw initially was the first few days. The cameras were there and the damage. Oh my God, this had happened. Then about a week later, the media's not there anymore. They're gone. The next crisis, right? But the financial damages went on for years. I mean, divorce rate doubled in LA County. The bankruptcy courts were jammed for 2 years. But you didn't even go to court. Went to bankruptcy court, you had to sit in the cafeteria. Because the cafeteria was so large, you could seat 800 people at a time.
Wow.
So you had 800 people sitting there back and forth, and I went there several times. I had clients that went there too also. And that's what it was like. It was a god-awful loss of wealth and money, and it didn't matter who you were. And that's when I got my epiphany, right? So I was selling deferred annuities, right? I also had sold some immediate annuities. And after having so many clients, there's one thing they had in common. I go, wow, this is interesting. The people who had their immediate annuities, guess what? They got to keep those.
Yep.
If you had deferred annuities, they did not keep those contracts. Most of them didn't keep the contracts. They were gone.
They surrendered them out.
Yeah, that's right. Because so what I tell agents, if you tell someone they have a guaranteed lifetime income, you can say that, but you have to follow up and say, if you don't lapse the contract.
Yes.
To me, it's not fair to say, I have this deferred annuity and I can take a systematic withdrawal from it, or I can do a rider on it and you get a guaranteed lifetime income. I think it's okay to say that, as long as you also say all these things, as long as you don't lapse the contract. Yes, you can have a guaranteed. And the reason why I think it's fair to say that, because that gives a customer, what do you mean by that? If I don't lapse the contract? Well, really? Well, maybe I want a contract that can't lapse. We'll talk about one of those. So the agent is not letting the consumer have a fair enough choice, not getting a fair enough presentation because of the words they use, to describe what's going on here. If I say, well, FIA rider with a guaranteed lifetime income, I have to say, you get the FIA contract, here's your rider on it. If you don't lapse the contract, you'll get this rider. Oh, really? What does that mean? Well, really? Well, maybe I don't want that. Maybe I want something, or I may want part of my money that can't lapse. And maybe, so I'm trying to say I don't think people should abandon deferred annuities altogether because we have this economic crisis we're facing. I actually foresee a much more demand on assets next few years or so to work out this interest rate issue, which seems to be going on right now. But there needs to be a mix of some kind. People need to own. There's been too much one-sidedness. Too many savings accounts are being sold, and there needs to be more of a reasonable mix where people have more permanent type arrangements, and then maybe with some savings arrangements. But to completely abandon the permanent arrangements, I think is going to be a mistake going forward. I think now is a good opportunity. Rates are up, right? So good time to talk about them than they were a couple of years ago. But I was talking, one thing I think is really funny is that actually a better time to buy an immediate annuity was probably a year ago, believe it or not, when rates were lower.
Why
and the
is
reason,
that?
well, I talked about this, I was saying about it, because the reason why is because look at this way. Okay, you can't place now. Immediate annuity carriers get all hinky about how much premium you place, right? The annuity purchasability rules for placing immediate annuities, because they're illiquid, right, is a little bit different than the rules of playing deferred annuities. So you can't get away with much, right? So when rates were lower, right, last year, people were what? They were wealthier, right? They had more money. Now they have a lot less money because they just lost, 30, 80% on ARC or whatever they lost the money on. Okay, so they have a lot less wealth now. But if you can only if your maximum purchase is only based upon their liquid net worth, you can't count their house or the cars, right? So the liquid net worth has diminished 30%. Well, you can only buy so much immediate annuities.
Immediate annuity rates are only up maybe 10%.
Yeah. I think people actually got screwed because now they can purchase even less than what they're going to purchase a year ago. If they had bought them when rates were at a lower rate, but they would have had better protection.
I get it. Yeah. So if 100,000 would have bought 5.7 annual payout, now it'll buy 6.5, but you only have 60,000 or 40,000.
Yeah, but now maybe you can't place that because the carrier will say, "Well, you can't." Now the thing is, the other thing is too, and I have been successful at some carriers arguing that people should be able to have premiums reflective of their attained age. And that's kind of a stretch. Most carriers won't go with that. It's just too much for them. But I've been successful arguing it for certain people that you should increase because I can't place premiums. Your maximum premium is going to be limited by their liquid net worth, pretty much, right? And so the problem is that I personally believe that people should be able to buy immediate annuities equal to their attained age, because that gives them max protection of not having anything in the future. Because now they are a lot more liquid, but they will have an income coming in if worse comes to worse, and they lose the other. Let's say they're 75 years old, they lose that 25% liquidity because it's gone in the market or something. Well, they're not in the streets, right? Because they get this income coming in, and they're going to be maybe okay or better off than they would have been if they only put 20% in and they lost the other 80% in the market.
Yeah, it's got to go somewhere, the difference that doesn't.
So the carriers are very, and again, the carriers will, depending on the carrier you work with, there'll be, some will say, no way in hell we're doing that. Some will say, okay, we'll do that, but it just depends on the carrier. So again, it's, we have to use that as a rule of thumb. You wouldn't know when someone who has $10 million, that's probably not appropriate, 80% of that. Although I could maybe make an argument for it.
I don't know. I think once you start hitting you got your 40, 50K a month, you're probably okay.
You'd be surprised because another person I talked to, I said, look at the type of business. Because I do some really strange business. So either the client I deal with is extremely wealthy. Really wealth beyond imagination, really extremely wealthy, or they're extremely broke. So I don't really have a lot of my own personal clients that I have aren't really in the middle anywhere. I said, I don't know why that is. I think it's because they don't really know who they are. If you're extremely wealthy, well, you're pretty wealthy. You just know that in your mind, right? And if you're broke, well, you pretty much understand that you're broke, and now you got to do certain things because you're broke. But if you're in the middle, you don't really know who you are.
Yeah,
am I broke? Am I wealthy?
Just enough to where you don't need. Yeah, you don't think you need it, and not enough to want.
Yeah, so that's the problem. And they get a lot of mixed messages from people, where people on the two barbell ends, they don't have mixed messages. They know who they are already.
Yeah.
So that tends to be my client base, and people, and we can maybe do in that video by why someone who has $10 or $20 million will even entertain a SPIA. But I get that all the time. I had a couple cases. I didn't put it in place, but they're all several $1 million of premium that replaced SPIAs. And
out of all the SPIAs you placed, and while working at Presidential Life, you guys did an enormous amount of premium over there some years.
We did
with us. I know a lot.
And that was Presidential Life at the time. The company's profile was basically 60% of all our annual premium were in those contracts.
Yeah. And out of all that stuff that you saw come in, what would you rate the satisfaction rate?
Well, 100%.
That's what I find.
An owner never complains about the SPIA. Never. There are other complaints about them, but usually not from owners.
Not the owner. Beneficiary, maybe.
Beneficiaries. Yes. That's another sales issue to deal with on a large contract.
We're just talking about the immediate. I've noticed this in the ones we've sold to old employees or family and friends. They just love it. And they've gotten all their money back, a lot of them, because the rates were so high when we sold them. Some are at 10% payouts, in P&I payouts that they're now on just I. So
So that's the thing. So when rates were better, Okay, that's another reason why I never get a complaint. There's never any regret because they purchase these contracts. I have even contracts that I sold like even 2 or 3 years ago. I talked to a couple of people. I said, it's not happening. You just, you're not, maybe now, I don't know now, but I said, so you never get a complaint from an owner. Very unlikely to get. I've never, I don't think we ever had any complaints from owners.
The only problem that comes up is they changed their address, they changed their bank account, they didn't tell anyone. Something like that. That's what you have to deal with, little service issues.
Right.
And that's even very rare. They're usually pretty good about telling.
Right. So while the owner's alive, usually it's smooth sailing. It's only what happens is because the nature of the contract, when the owner dies, then you have certain things that could, be annoying to beneficiaries, or certain beneficiaries get annoyed they even had that contract in the first place. So you can only,
and others are very happy they're getting a check for the remainder of the guarantee period. So.
Yeah, people are happy with that. Yes. Yeah. And so it just depends on the case, but so that's another thing too. The agents don't have to worry about that. And for the annuity side, there's not these long tail things. So I always talk about that too, that if you're going to work in the SPIA markets, and I'm already I'm not in my 30s anymore. So I'm already in my 60s. So next person dies. I might be dead before my next client dies. So I don't really, when I was in my 40s, I don't worry about the tail risks as much as I used to when I was in my earlier, because I might live, 20 years and be an agent and then have to deal with a disgruntled beneficiary or something. There would be a problem with that. But I don't really worry about that anymore. But that's, again, the difference between an immediate annuity and deferred annuity is that agents have these kind of really long tail risks, and I talk about that, how to mitigate that. And when you're doing the selling process, application process, that you want to make sure.
Notes and disclosures,
lots of notes. I do everything by email pretty much now. So everything's in writing, but you just know that you have to do more work with them. It's not just you're going over doing an app and then you're done with it. It's a little bit more risk to the agent, to mitigate. And then, carriers of, I don't want to get into the carrier issue. I'm not really happy with the carriers regarding this anyway, but there are just, things that have happened recently that have put them at odds with their agents regarding, some of these contracts, and when people at the end of time, when people die and everything. So, that's been a problem. But other than that, I do think that's the place and time for them. I think that we're going into an economic crunch here. I really do.
Well, even
and I think that people are more risk of losing their assets. They really are. I had a case. I moved to Boca, right? So moved to Boca 8 years ago. 2 restaurant owners. So I came to Boca within about 6 months. I sold 2 contracts, and these were deferred income contracts. So the immediate annuities, right, with long deferral periods. In the old days, we called them deferred immediates. We don't call that anymore because of obvious reasons, but they call them deferred income contracts. So they were very big contracts, maybe 50,000 each or something, So what happened in Florida? And this is afterwards. 2 restaurant owners, they lost their restaurant, right? Not their problem. They were fine. COVID-19 came, had to close the door, couldn't make it. They had to close up, right? Yeah. But so they lost their wealth. A lot of their wealth was tied up in that restaurant. But they had the deferred income contracts, right? Now, if they had a savings bond portfolio, or they maybe went to the broker and bought, I'll just buy T-bills. Well, what do you think those T-bills would be? They'd be friggin' lapsed. They wouldn't be enforced anymore. They would close that brokerage account, a while ago, Yeah. So that's the problem, is that these are permanent contracts, future income. And so they were able to keep their contracts. They both did bankruptcies. And Florida happens to be a homestead state for bankruptcy issues for contracts, like Texas. A few of the southern states happen to be more homestead states. So they were able to keep, and they weren't like monster contracts. They were like millions of dollars. These were just a normal contract an average person would buy. So the court doesn't have any, suspect problems about that or anything. They bought when they first came down here, So it was they got to keep the contracts pretty much. But then what happened, which I just found out about a year ago or 6 months ago, because one of the restaurant owners lost her business. Guess what? He's going to get a divorce. Very common, right? Bankruptcy, and then that's the right hand hook with the left hand uppercut. Divorce is the next thing. So, and guess what? Now, there was a marital interest. He bought the contract with marital money, right, on his life, payable in 20 years. But guess what happened? She disclaimed her interest in the contract. Why? Well, who wants to wait around for 20 years to get some payments only be made if the person lives? No one wants that. So he was able to keep his contract. Now, what did he give up? He gave up a used BMW.
Okay.
For her to release her interest in the contract. What do you think that BMW will be in 20 years from now?
Nothing. If it's
nothing,
running. And those things are expensive to repair.
He gets to keep his contract. So that's what I'm saying. They have these kind of ancillary, wealth protection dissuade people, from, well, it's not really valuable to anybody but the person who owns it, right? That's who I have the value. I own it. People outside of me, they can't take me off the contract. They can't stop the process. The payments come in. I mean, it can't be manipulated by a third person. The third person doesn't really have an economic benefit. I mean, she could have waited if she wanted to. That would have been possible. Then she would have had to share the benefit. Yeah. But that just was not practical. In fact, I worked in the pension business. Most of the time, I'd say 75-80% of the time, the pensioner was a male. And again, that just gets the demographics of the country and men working longer and women not in the workforce for very long. So typically men accrue pensions, even today, if there are pensions, more frequently in bigger amounts than women do. So it's usually the man's pension. It's still the case today, no matter what they say. So, and a lot of times the woman will just surrender her rights in the pension. And and my company primarily represented women. We were trying to get them to not do that, to get a good exchange for value or something going on. That's what we were hired to do, basically. And that was very common. And so that's just another wealth protection mechanism, right? So divorce happens, it's not your fault, goes on all the time. It's hard to deny it. Divorce rates are huge. In fact, we get into real economic crunch here, Jeff, the next couple of years. I tell you right now, you'll have, bankruptcy lawyers and divorce attorneys licking their chops about all the business we'll be raking in from all these people going under, in 2 or 3 years from now. So this stuff is all going to happen. It's not something that you're a bad person or did, but this is just your situation. And most people don't have their wealth, in areas that protect them from these types of things. They don't. They have Social Security and that's it. Everything else is just a savings account. It'll be just like any other savings account they have. And again, you want to have a happy medium here.
Well, I've been seeing that the income is so important that institutions are looking at how much income you have. They don't care you got $1 million in the bank. How much income do you have? If you want a loan, if you want this.
That's right.
Had people looking for 3-year period certain only so they can secure a loan. I have to show income for 3 years. It's just, you're just taking your lump sum, putting it in immediate. And they're saying that because, you have it, but we don't trust you to keep it. So we want it in immediate. So we know it's coming out every month. So the institutions even like.
Well, institutions letting them do that. Now, institutions maybe know that was only for a 3-year period. They may not make such a loan. But again, this is the fault of our system, right? It's like they don't care. Well, why should they care?
They're requesting.
We're going to sell the loan tomorrow. And so now it's going to know shit about it. 3-year annuity that goes owns. And that's the kind of shit, that's the kind of stuff we deal with all the time in this country,
Yeah.
So, this is just indicative of what's been going on. All this, in my opinion, is just all this low interest rate environment. All this easy money stuff has been going on. People have just got away with friggin' murder. And then now it's ending. Have you seen that scene in Constantine? At the end, the devil and angel, the archangel, they're going to fight each other. And the angel goes to throw a punch at him.
I think that's a Keanu Reeves one.
Yeah. And the angel is stopped, right? Because God stops the angel from hitting Satan. Satan looks at him and goes, it seems like someone doesn't have your back anymore. Because she did a bad thing, right? So she's being punished by God. But that's just what's happening. The Fed just doesn't have our back anymore. And they're probably not going to have it until this economy crashes, and but then it will be too late, Jeff, because it won't matter anymore. If the Fed is not successful really at fighting inflation, whether they increase or decrease rates anymore aren't going to matter. What's going to matter is at some point in time, the investors, bond investors, are going to say, Jesus Christ, this isn't working. And now, after all these years, we want a real return. We don't care if the Fed rate's 1%, 2%. We don't care what the Fed rate is, because obviously they'll never be high enough to deal with this. We want to get real returns. And if that were to happen, that would mean rates would have to be astronomical compared to where we are today.
Yeah.
If the bond vigilantes, the bond people ever woke up and said, oh my God, we're not waiting for the Fed. We want returns immediately. When all these bonds all this stuff gets repriced again to account for an inflated environment, there'll be a drop in asset value like crazy. So I'm not, that's my opinion. That's how I see life, see things that way. And people may not have that opinion, but I think people would be much better off instead of having all these savings accounts if they had some more than Social Security. So let's say your Social Security was $1,000 a month, double it. Whatever it takes to double your Social Security benefit, double it. If you can afford it, put a rider on the contract and have a self-adjusting contract if you can afford that. Because I don't think there's going to be enough wealth set aside. And again, maybe majority will be okay still. But what does that mean? 51%? I mean, what's a minority? 1%? Is it 9% or 49%? It's still a lot of people, even though it's not a majority of people, but 40% or 49% of the country is still a lot of people, so it doesn't even have to be a majority.
Yeah.
We're talking about millions of people here in the minority. So I just think there's a room now here for people to start doing, and I realize, and I don't expect agents to do this, to talk these things up greatly, because obviously there's a income issue going on here with the agents, but I think that they would be wise if they wanted to be in the business for a long time and keep clients for a long time. They should start incorporating more SPIA business into the normal annuity business and not just relying 100% on these riders and savings contracts, because you just don't know if they're going to be enforced. There's no way of knowing for sure whether that client will be the lucky client, being 51%, and keep their contracts and draw on the contracts and die quietly in bed with all these people around them, loving, holding their hands. That's a fantasy, by the way. So, if that's what you think is going to be, most likely that's not going to be that way. Usually it's always a drama at the end. But I'm telling you, I think population would be better off if they had more ownership of non-lapsable, permanent future income contracts. There's just no way protecting households, from I think this stuff is going to happen. That's going to just really rip their wealth up, So yeah. I'm a big proponent of them. That's the whole the book I wrote. When I left presidential life, they still work.
And is there any difference between like a legal aspect of an immediate compared to a deferred, where your assets are more vulnerable, say you're found culpable of something? Or
yeah, you have state protections, like you have these bankruptcy protections in certain states. You have creditor protections in certain states. Again, they're not huge. You're not going to be able to shelter millions of dollars in these protections. The courts will look at that as, you've tried doing that. I get questions about that all the time. It's probably going to be a sham transaction, and they can get around that. Okay, so
it's done in advance, and it's
it's reasonable for the person, and it's done way in ahead of time, like insurance. Okay, you buy insurance before you need it, right?
Yeah.
So it's the same type of idea. You get these things in place; they're done. Same thing with the for example, the Medicaid. Transfer asset issues, a 5-year look back. So. As long as you give this thing plenty of lead time, chances are no one's going to challenge it. It's not a significant part of your wealth, although it's part the wealth you may end up relying on, because maybe your other wealth is not here anymore. But as long as it's done within that context, then mostly you're going to be okay. You're going to be okay from these other issues that could pop up down the road and hammer you, from a legal perspective. Again, like I said with the divorcing person, it's just a very unattractive asset. It's very unattractive for people to try to make a claim. Well, they can make a claim, but who wants to? No one wants to do that.
I've had the divorce thing work the opposite way, where one spouse didn't want to have to pay the other spouse regularly, so they wanted a SPIA that would just directly pay it up front, and they were the beneficiary.
Yeah, because that's because the receiver of the income doesn't trust the payer of the income.
It could be that part
to not go broke. I mean, isn't it? He or she doesn't trust them to not pay it willingly, but maybe they don't have any assets anymore. Yeah. Maybe they're in Hollywood. They're producing the film business. I had a lot of those. They're always on the street. I mean, so it's like, you never know what could happen to you depending on what kind of business you have. So if you get a divorce, the other person, well, you have this money now, I want this contract. You buy me this contract.
Yeah.
There's a certain procedure to that, and things you gotta, it's not just such a simple transaction, but
no, it's a lawyer.
Yeah, that's the idea behind it. So that's, again, it's security. It's so the future is going to happen the way you say it's going to happen. Without
check's going to show up on the date it's supposed to show up every time.
Yeah, without any deviations. The same thing now was Los Angeles. Also, of course, I was a structured settlement broker for 5 years. I worked in the structured settlement industry. Same idea. Why do they use these contracts? They use the contracts because their future income, the contracts won't deviate. They don't have to be managed by third parties. If you have a mother and a child, it knocks out all the predatory behavior of the family, if the child's getting a settlement.
It's all good stuff.
Yeah, so these are all issues that kind of revolve around these contracts. And again, they do. They just wait. They just wait for creditors.
Can you talk on two issues? How about a COLA? Not things we hear about a lot, and exclusion ratio, something that I cannot believe how many people don't know about.
Well, cost of living adjustment, again, what you're doing basically, a cost of living adjustment is that you're going to build a deferral in the contract, right? So there's two ways of looking at it, right? Either more premium or lower benefits. Okay, so the way I talk about it with consumers is I never show the lower benefits. I always show more premium, because you're taking a feature, right? And it's going to cost you more. So if the non-COLA policy contract was $100,000, if you want a COLA, it's going to be $110,000. But I don't show it $100,000 with the reduced income. I show it with the extra premium cost, because I want them to diminish. I don't want them to think that their income is being diminished. I want them to think they get the same income coming in, but if they want something more than that, then they just have to pay more money. That's honest
brilliant.
Way. That's honest way of putting it. It's more honest to do it that way. Say, look, this is the cost. Yeah, you reduce income as a cost the other way, but really, it's too much hard for them to visualize that.
So tell them $1,000 a month costs this month, and $1,000 a month at 3% COLA costs this month.
Yeah, and it's easy because they're going to write you a check, right? So, they write a check for $100,000 or $100 check for $110,000. See, what do I want? So the benefit's the same, but so that's the way I usually present it. So the thing is that COLAs are expensive, like everything else with low interest rates, right? They're deferrals. So as years go by, the carrier has more money. Initially, when they paid the premium, so they had money to pay these deferrals, right? These increased payments. So they become more expensive. I haven't done one for a while. And you have, compounding annually or simple interest COLAs, you can get a little bit. But so to make it easier for consumers, and it's a lot more work for the agent, but is cheaper, I say, well, we'll do, if you really want to do that and you want to spend more premium, but don't want to spend that much premium, then we'll do separate contracts. So for example, so I might have a contract, for example, at 65 with the base contract with what they wanted. Then we'll do a contract at maybe 70, then maybe 75 and 80. So maybe so I might do 3 apps. I mean, there's a lot of apps to do for smaller premiums. because those extra apps are basically your independent COLA adjustment, right? So but the good thing with that is that it lets you be flexible, right? So let's say they don't want to spend that much money. Okay, well, maybe I'll take the base contract. It's going to cost me $100,000. But, I don't want to pay this extra, 35 grand for all these other through the contracts. So, okay, well, what we'll do is maybe we'll change the terms of those contracts. What we'll do instead, maybe we'll do life contingent contracts, if that's okay with you. Because that way you won't have an estate benefit for the COLA portion. You will for your base contract, but it's cheaper for you because they're life contingent COLAs, right? So he goes, well, yeah, maybe I'll do that. Instead of spending $135,000, I'm only going to spend $120,000 on it.
It won't be an annual increase. It'll be
every 5 years.
Increase.
Yeah. So the problem is for the agent is that's now you got to figure this stuff out. When to start the payments, and maybe you have different contract, maybe you have different carriers. I mean, that could be the possibility too, is maybe you've gone through this stuff and you say, well, I can even make it less costly because I can get these deferred contracts cheaper if there's one carrier, or you may get the 5-year contract cheaper, the 10-year contract. So you could end up with, it's going to be a real mess.
Kind of the way we always used to do things.
Yeah, kind of what we used to do.
Kind of,
but see, and I don't,
a lot of time.
And personally, I don't go there now. If the premium's large enough, then I might, go down that road. Other thing you could do is just, or most times you could probably get away with just looking at a single carrier. Because again, a little bit different. Okay, income contracts are not aggregated, so there's no serial contract rule.
Yes.
Okay, so if I buy a base contract for one carrier, and the same carrier buy 2 or 3 different smaller deferred income contracts, those are all independent contracts for tax purposes. They're not aggregated like you would buy like a deferred annuity and get into this problem when you're doing withdrawals. Well, you bought the contracts all in the same calendar year. Now they're all serial. It's a serial contract. You can't withdraw. So that's the problem you get into deferred annuities when you sell multiple contracts from the same carrier the same year. But that's not the same way for immediate annuities. There's no aggregation rule. So, and again, it's one of the tax amendments, like you said, immediate annuities, because the IRS has these rules. Well, if the annuity conforms to these rules, and it's this the way the annuity is designed, then you get this benefit where part of the money you get back is reflective of the premium paid, and part of it is interest you earn in the contract. Okay, so again, that's how the IRS defines what an immediate annuity is for tax purposes. In fact, that's what most people say an immediate annuity is. They'll say immediate annuity is a contract that pays within 12 months and starts the payment right away, and that's the immediate annuity. But that's really not what an immediate annuity is. And what immediate annuity is, actuarially, is an immediate annuity is priced immediately. The fact that it pays within 12 months has no bearing on whether it's immediate annuity or not. If it's being priced immediately and the payment set, that's the immediate annuity. For the IRS purposes, for the IRS definition, well, that's the immediate annuity that pays, because that the IRS uses to give certain tax benefits.
Yeah.
But that's not what that's only the IRS's position for these benefits. That's not, but that's not what immediate annuity. But I lost that war. I don't even fight that war anymore.
Yeah, because if it starts after
immediate pays within 12 months, so that in my mind, I go, well, you know what? If you were in a home office and you were meeting with a bunch of actuaries and you were an elected officer, you say, well, we're going to sell these immediate annuities, and they start the payment within 12 months or immediate annuities, all the actuaries would be laughing at you. What an idiot, you know?
Yeah.
But I don't talk about that much more social media, because it's just little people, they just use the IRS definition because that's how it defines it.
That uniqueness of the principal and interest is what gives us the exclusion ratio.
Right. So that's why, because IRS has over many years, and they've actually taxed them differently. If you look at the history of how they tax these things, the IRS never really had a good handle on this, ever. They've always had different methods.
Really, I always thought it was just as a normal income.
Yeah, they always had these weirdly weird ways, because the deferred annuity is easy to tax, right? You have a cash value, interest is credited, you make a withdrawal, so that's not as difficult. The immediate annuity is always, and this is the problem we have today, actually, why all these different weird tax methods is because IRS if you go back even the 40s and 50s, before my time, and look how they were taxed, I mean, all these were attempts to find some way that was logical to tax them, because they don't fit the same parameters of interest being credited to your account, you earning interest and you make an interest withdrawal. That's not how they work, right? So as time has gone by, immediate annuities taxation has morphed. What it is today wasn't how it was, 40, 50 years ago. Tax rules were different for them back at that time, and they've changed them. They've actually made them probably worse. They were better then than they are now. Everything was better then. But,
so the exclusion, break it down. Why an exclusion ratio is so great for people today? Like the high taxes, maybe they're in a tax bracket. Is that why it's mostly, maybe someone would lock it up?
Well, pretty much it's the reason why is because you get this income to spend any month, right? Say you can get $1,000 a month to spend. Okay, so let's say, for example, was this in a savings account or a deferred annuity contract? You took $1,000 amount to spend. Well, what's going to happen is the interest is taxed as interest income. It doesn't matter if it's in the account for savings account or not. You get taxed. Deferred annuity, or you get taxed only if you take it out, but you're going to take it out because you make a withdrawal, right? You got to pay 100% taxes on the interest first, right? Same $1,000 a month. On the other hand, if I have an immediate annuity that gives me $1,000 a month, because of this tax benefit of saying, well, we recognize that part of this money you're getting is going to be what they call cost basis, return of basis. You paid money, again, it's not an investment, right? It's not like it's a cost basis. You paid a premium. This is your cost to buy the contract, not invest in the contract. Okay, so because you're buying the contract, you have this cost basis, all right? So what's going to end up happening is that the IRS says, well, again, for society purposes, it's a benefit to society that you can take $1,000 out of this contract. And as a tax benefit, you only have to pay tax on $100. The other $990, we will deem, because we're being good buddies to you, as being a tax benefit for owning this kind of contract. And you can spend that money, and you're not invading the principal. Why? If you withdrew the principal from a savings account or a CD, well, what happens? Well, you're going to earn less interest the next month, right? Because you keep invading the principal. But because the immediate annuity isn't built that way, it's the same payment every year for as long as you survive. It doesn't matter they return for tax benefit purposes, part of the cost basis, because it's not diminishing your income. So, for example, if I had a passbook savings account and I earned, say, 3% interest on it, and I took a withdrawal for 4%, right? So part of that money I don't pay tax on because that's part of my capital, right? So, but the next month I'm going to earn interest, my interest is lower because I have less capital invested. So the advantage with annuity is that here you get this kind of benefit of having this kind of cost basis return, but you never have it diminished. Your income is always the same. It's never being diminished. So even if your deferred annuities or your passbook savings accounts, they go down to zero, again, it's the same principle. If I had a savings account at a bank and it was earning 2% and I made a 4% withdrawal, guess what? Well, 2% of that, I'm not going to pay interest on because that's part of my capital, right? So every year I off my capital, it makes it harder and harder for that bank to continue to pay me the same interest I had because I have less capital involved unless rates go up or something happens, So I have this diminishment happening all the time, this risk with a bank savings account that, I keep withdrawing my capital. Oh my God, if I draw it down to zero, I'm not gonna have any income. There's nothing left, right? So that the advantage with annuity is that, well, it doesn't matter that you're getting some cost basis return because it doesn't affect your income. Your income is always gonna be the same as long as you live 100 years or 30 years or not 100 years, but 30 years, 4 years from now, you get the same income, you diminish your capital. Okay, so you diminish your capital, and again, I also say, when that time comes, the new tax rule used to be that you always had that cost basis issue. But then about, I think, 95, they said, well, we're not going to be that generous anymore. Once you recovered your cost basis, then it just becomes all taxable at that time.
I didn't know it was ever different than that. Interesting.
Yeah, it used to be, I think up until 95.
Wow, that's right when I started.
They never had a cost basis break. It was just once you had that amount that was non-taxable. That just went on.
That's because it was right before my time. That's why
That went on forever. There were other ways before that they taxed, and then they thought, well, that's just too generous. We can't, we'll look at that again. And
they're getting killed on that.
they
must have been getting killed.
they
People
cut
are
that a
living
while.
longer. People started living way longer and everything. In that
Yeah,
time.
they cut that benefit. Again, this is all contrived by the IRS. People aren't really getting. Think about economically. When you buy an immediate annuity, you didn't really make an investment. You paid money for that, right? So you economically, you never get a return of your money. Okay, this whole tax basis thing, this is all contrived by the IRS, trying to find a method in which to tax this future income you're getting. Okay, so the way they come up with is this method where they have these tables. They say, well, based upon this table, then we're going to give you so much of this benefit is going to be every year, and you don't have to pay tax on this. But in theory, what happens is you paid the premium. That was a cost to you. And that money's gone. You spent that money.
Yep.
The only thing you got to come in is the future income.
Yes.
So this is a little bit different mentality. Most people don't look at it that way. They think, well, I got this money, it's an investment. I can sell my investment, or I can withdraw from my investment. But most people don't think about SPIAs as spending money. They think about investing the money, right? Again, it's a word issue that agents need to get around. So again, you're buying it. It's a cost. You're not making an investment. You're not getting your money back. What you are getting is this benefits, this income stream in the future, guaranteed by the contract, and the IRS will tax it this way. This whole idea of cost basis being return of your principal, that's non-economic. That's just really a tax issue. The IRS has settled on. This is how we're going to end up taxing it. But in reality, is you really never get returned to principal. You just have this income coming in, and that's why the IRS has struggled over the decades to figure out how to tax it. Because, well, how are we going to tax this? And there was a time, back in the 50s where none of it was taxable.
Yeah. I tell people all the time, I'm like, the difference between a deferred, you could strip the interest and you could take 10 or 5 or 6% out, or 4% rule even. But what are you going to do if you do live too long? And you start looking and your account's dwindling and dwindling. You're like, wait, I got 36 months left. I got 20. That's going to stress you out and maybe shorten your life more. Whereas the SPIA person's like, I'm going to live one more month. I'm getting that next check. It's like
and that's the kind of, that's kind of with all these things, not just deferred annuities, but savings accounts, mutual funds. Obviously, if you have a non-qualified account, you're going to take out more than the interest earnings, right? You're just not, people are just not in a situation where they live alone on the interest earnings, or maybe only the gains in mutual funds. If you have gains, living off the gains only, that's just not going to happen for 99% of the people. You're going to be drawing that capital. And every time you draw capital, that the pressure cooker starts going. Oh my God.
You got to earn more to get the same.
I do it through capital. And it's the pressure that real people feel when they're older because they can't replace that capital. So this whole tension, this whole friction issue, it happens all the time. And so to alleviate that, people say, well, maybe what I'll do is I'll just buy this income contract and I have to worry about making my withdrawals. It's the money coming in, it's either period certain, life contingent, or whatever the mix is. And that takes all that friction away. They don't have to worry about this teetering on this decision. They take too much, they take too little.
I gotta say, this is a
my
perfect place.
Out, this is all a problem we're facing with zero interest rates. I think people got away with a lot more. And people who were savers, right? Traditional savers that were more conservative, really the pressure was on them for decades. You couldn't be, no one was paying you any interest, right?
Yep.
So what did you have to do? You had to gradually, because you're afraid, take these other risks, either in the market or maybe illiquidity risks or some other kind of way of making some gains because you're freaking out. You're not earning any interest at the bank, right? So this has been going on for 20 years. People have been gradually, savers, not investors, have been gradually shifting from their prior behaviors they had when interest rates were more reasonable way back in the day. And they got in these other areas that they either weren't accustomed to, or maybe they're too much. Maybe they went all whole hog and went in the markets and, and things were great for 15 years or 20 years now. And the worm is turning.
I'm telling you,
interest rates have escalated. These are not coming down anytime soon. They may come down, but we are in for it.
We're not
so
going to
all
see what we
this past behavior it's going to be reversed. And most people, I think, aren't shocked from it still. I mean, I've talked to people recently, financial market, they can't. I mean, I've talked to people who they've already lost 80% of their savings.
That's insane. That's crazy. And 80%. We're not even down that far.
I mean, now,
hey, Gary, I think,
fortunately for them, they're very young.
Gary,
so
I want to leave it right here, because I think this is a perfect place to just say the main thing about an immediate annuity is peace of mind.
Peace of mind, right? And you got this income coming in, and you're not going to be able to jeopardize it. So that's
the peace of mind worth to you? That's your insurance premium, extra premium or premium variable.
Right.
Gary, I want to thank you for spending so much time with me. And every time we talk, I learn more, and everybody learns more by listening to you. And your deep knowledge of the past and your experience is so great. And again, it's so nice to have someone who still speaks my language, if you will.
Yeah.
And,
so
you want to push you have a book and everything, I know. And
I did a book. I did. I decided to write a book. I don't think there was any one book anywhere that was only on immediate annuities. I mean, people talk about immediate annuities as parts, like small parts of other annuity books or small parts of other financial things. But I felt that they didn't have their own thing, So it was my attempt to give them 100% attention. I mean, it's 65,000 words. So the editor thought there's no way in hell I could write 65,000 words about the meeting. I go, well, I don't know. I might
Surprise. Surprise.
So we kind of threw this together. And again, it's done in chapters, and it isn't that one chapter follows the other. I mean, you can pick out things you want to read. It's like having 10 independent white papers all bound together. So the different topics, different things. I do like people to read the history. Can I go forward? It gives you a good foundation.
I love that. It's
about it,
the history.
Like that's how I come to my conclusions. Basically, is from historical things that happened in the past. And
I couldn't even believe how long ago when I was reading. I'm like, wow.
Yeah, I mean, this is all things that happen. People don't realize that people have lost the historical perspective. Because we haven't had these things don't happen too often. We have these crises like this, and typically. I was talking to someone on LinkedIn the other day. I said, you know what? I said, well, if it wasn't for the Great Depression, we never would have had the annuity business. And that's the whole annuity business sprang from the Great Depression, basically. And that's why people bought annuities, was because they didn't wake up in 1930 and say, oh my God, I'm going to run out of money in 1960. I better buy a friggin' annuity. That's not what they were thinking. They're thinking, oh my God, I better buy an annuity the banks were all failing. The government seized the gold. Well, the gold was seized in 34. So I'm going to go broke tomorrow. I better buy an annuity. That's what they were thinking. But we don't think about that nowadays. We just don't. We don't consider that because no one wants to look at it. It's just inconvenient. To look at that. So. And
I think I still have. This is what we need to look at here.
Oh my God.
There's book here, right?
Oh yeah,
right?
Chess piece, yeah.
Right?
PC correct chess game.
I will totally. I'm losing my background here. I will totally have a link in the description to the book right here.
Okay.
I'll put it in there for everyone if they want to look. And you can do that. I'll have a link to Gary's LinkedIn page. If you have any questions on immediate annuities, feel free to call me and Gary. Right, Gary? You're
absolutely.
And if you have any really unique situations that need an income guaranteed, that's your man right there. He will give you definitely direction in that. So
no problem. All right, Jeff.
I'm going to just stop this recording real. Hope you all enjoyed that. Thanks.